Good morning and welcome to this Wednesday, April 20th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're starting to get some more earnings reports out, and for some that's good, for others not so good. The not so good was Netflix. If you haven't heard the news, Netflix did beat its earnings estimate, but revenues were weak. Their guidance was horrible. They actually said that their subscribership dropped for the first time since 2011. So Netflix taking it on the chin this morning, currently down 28%. It's down $97, almost $98. From 348 down to 250. Now, this was a company that their stock was at $700 a share back in November. 700, now it's 250. So about 65% of the market cap has been shaved off of Netflix just in the last 6 months. Pretty scary stuff, but Netflix obviously right now can't get it right. They're talking about maybe cracking down on folks who are sharing subscriptions. We'll see how that goes, but it's also having an impact on some other companies that stream. Walt Disney, for instance, after gaining $4 yesterday, is down $5.70 today, so it's down about 4%. Roku down about 7% today after gaining 8% yesterday, so giving it all back here at the open. So Netflix, while obviously it's having a lot of difficulty this morning, it's taken down some of its competitors. But fortunately, and I'm a little surprised by it, but the NASDAQ is actually up this morning. The futures are up almost 0.5% on the QQQ. So, NASDAQ, I would have thought some of those shares would have been hit pretty hard. And last night after hours, they were getting hit. And the NASDAQ at one point, I think, was down over 1%. But it's rallied back and currently set to open up this morning about 0.5%. So anyhow, pretty good stuff going on in terms of the reaction, the overall market reaction to what happened to Netflix. I thought is really good and bears watching throughout the day. We'll see whether or not the market can continue to strengthen. But at least in the short term, I think the market weathered a pretty big storm. All right. First of all, welcome everyone. And for those of you who are new, I will start off as I always do over at Earnings Beats. Just so you know, if you go over to earningsbeats.com, scroll down, we have a free newsletter, our Earnings Beats Digest. Simply type in your name, email address, hit that subscribe button, and we'll get you set up. It's a 3 times a week newsletter, totally free, no credit card required. You can unsubscribe at any time. Very quick read, couple paragraphs and a chart. I think you'll enjoy it. I think you'll find some of it hopefully educational. That's what I strive for. But go to earningsbeats.com, scroll down, and you will find the sign up form in the middle of the page. Notice also we have historical performance over here. I just wanted to point out, last night we had our draft for our model ETF portfolio because we do it every 90 days and we do it on the 19th day of the 1st, 4th, 7th, and 10th months of the year. So January 19th, April 19th, July 19th, and October 19th is when we do these drafts. We fill out our portfolios with anywhere from, I think we've had as few as 6 ETFs up to as many as 10. Last night we had 10. But the last quarter was actually very strong, given the fact that the market was down over the last 90 days from January 19th to April 19th. The S&P 500 was down 1.56%. And our model portfolio, ETF portfolio, actually up 2.35%. So we did outperform by almost 4 percentage points, which is a pretty big beat on an ETF portfolio over a fairly short period of time, especially when you're, looking to diversify and so forth. Most of the time, there isn't that much of a difference between our model ETF portfolio and the S&P 500. The couple of times that we did see some weakness in our portfolios, it was due to the growth stocks when the growth stocks were falling. Other than that, we've actually held up pretty well and outperformed. I think we've now done this 6 quarters, and I think we've outperformed 3 times and underperformed 3 times. So It's obviously a strategy that's continuing to evolve, but we have been, and last quarter, we were very conservative in the model ETF portfolio, given all the things taking place in the market. And I think that certainly was the right choice, as you can see from the performance there. Our stock portfolios right now this quarter are actually hanging in pretty well also. Since February 19th, and we'll do our draft next month for our stocks. So we just stagger it. So we're not doing them all at one time. But from February 18th to May 19th, that's the current quarter. The S&P 500 right now is up 2.6%. And you can see all of our portfolios hanging in there. A little bit of a outperformance by our aggressive portfolio, but otherwise pretty much right on cue with the S&P 500 this quarter. All right, so what happened yesterday? What happened on Tuesday? Well, the Dow Jones was up 500 points. That's pretty good news. S&P 500 up 70, NASDAQ up 287, mid caps up 59, small caps 24. So on a percentage basis, everything up from about 1.5% to about 2.25%, with mid caps being the leader, up 2.25%. As far as the sectors go, 10 out of 11 went higher, including discretionary, up almost 3%. Real estate up 2%. Communication services up 2%. Communication services probably going to get hit today as a result of Netflix. But anyway, it was up 2% yesterday. Technology was up almost 2%, 1.9%. And energy was the only laggard. Crude oil prices pulled back. I think we finished down about we finished at around $103 a barrel, I think, yesterday, which was down a couple bucks or a few bucks. So energy took a little bit of a hit to the downside, but on a relative basis, I think you can see energy continues to be the best performer among all of the groups that are showing here. But overall, good day yesterday, 10 sectors higher out of 11. So that was good. The 10-year Treasury yield, I think we have one more housing report. This has been kind of the week of housing reports, economic reports. And I believe we had one more, or we have one more existing home sales, I think. Yeah. March existing home sales coming out later this morning. February was 6,020,000 units. We're expecting that to drop to 5,860,000 units. But we've had mixed reports so far this week. I think it was the housing market index that was out on Monday, and that came in a little weaker than expected. I think it was either 77 versus 78, or maybe, yeah, I think it was 77 versus 78. So it came in just slightly below. But then yesterday we had the housing starts and building permits both come in ahead of expectations for the month of March. So that was good. And then, of course, today we have existing home sales. So we'll see how the market reacts to that. Currently, latest 10-year Treasury yield, we are at 2.9%. We're down 1 basis point from yesterday's close at 2.91%. Unfortunately, the 10-year Treasury yield, as I talked about a little bit more extensively last night, it's going up for all the wrong reasons. And that's why the overall market isn't going up with it. Normally, if you look long term, and this may not make great common sense to you at first, but when the 10-year Treasury yield, when interest rates are climbing, the stock market usually climbs with it, because the reason you bail out of bonds is because of a strengthening economy. Or that's one of the reasons. You also can bail from bonds due to inflation, and you can also bail from bonds ahead of the Fed, who's already announced that they'll be bailing from bonds. So you're kind of front running. And I think it's those latter two, the front running and inflation and the Fed getting out. I think all of that combined is what's sending this yield higher. I don't think it has much, if anything, to do with the fact the bond market believes the economy is strengthening. I think it's quite the contrary. I think we're looking at potential weakness later this year, potentially a recession, certainly a slowdown, if not a recession. We'll see how deep it goes. But yeah, so the 10-year Treasury yield moving up has really not resulted in market action moving up. I mean, again, here is your 10-year Treasury yield. Let me show you the S&P 500 during March and April. Here we were going up with it, but now look what's happening. We're turning around, going back the other way. So we definitely got some mixed signals here between the markets, various intermarket relationships. And we'll see where this takes us. But for now, looking at the S&P 500, I think we're sideways consolidating. I think obviously we set a very important top back at the beginning of January. I don't think there's any doubt right now what is the major resistance level for us, that ultimately it's going to be that breaking back out to an all-time high. To the downside, with a very high VIX, I think our VIX was up around 37 or 38, maybe 39. We set a panicked low back at the end of February, down, from a opening and closing standpoint, down around 41.50 to 41.60 in that area. Intraday, I think we got down to about 41.15 or 41.20. Let me see what that low was. 41.14.65. So basically 41.15. So we've established the top and the bottom. Right now, what I think we're doing is just simply going back and forth, consolidating. So here, maybe you get excited because you go through the 20-day and then you go right back down beneath it. Then you get excited again, right back through the 20-day and then right back down beneath it. Here, we took an extended move through the 20-day and then right back down beneath it. Yesterday, we came back up, closed above the 20-day. We got futures pointing up. So now we're back up above the 20-day. This is a sideways going nowhere trendless market. That's what happens. The moving averages really don't mean much. They mean a lot when you're trending. They don't mean much when you're just going up and down. We could see this movement for another few months above and below the moving averages. We could see the 20 crossing below the 50 and 20 coming back up above the 50. If we continue just to chop, you're going to see a lot of movement above and below the moving averages. Because as you chop and you get into this range, the moving averages are going to be sitting right in the middle of the range. The moving averages won't go anywhere. Here you can see moving averages are going up. Temporarily came down, then we go back up again. But once you start sideways consolidating, you start getting this up move, down move, up move, down move, and your moving averages, and they cross over each other and prices going above and below. And really it means absolutely nothing until you end the consolidation period. So right now I wouldn't make a whole lot out of climbing back up above the 20. It beats the alternative of trending below the 20 and going and setting new lows. But I wouldn't treat this as though now we're starting an uptrend. I think there's a lot more work that has to be done. One pattern that I have pointed out recently, and I'll point it out again, potentially, I don't think this is going to play out. Potentially, we have a bullish inverse head and shoulder continuation pattern. Off of this high, this is your left shoulder. Here's your neckline. Lower low puts in the head. Come back up, you've got an upsloping neckline. You pull back, you put in the right shoulder, which right now is upsloping. It's got a bullish feel to it. The problem I have is that the groups that have been leading the market during the up moves and so forth is not what we want to see, and not what we would normally see in a market that's getting ready to take off to the upside. So I recognize the pattern, but I would just simply temper some of the enthusiasm until you get a breakout. Now, if you get a breakout above that trend line or the neckline right there, that would be much more bullish in my view. Got a long way to go. I mean, we'd probably have to clear 46.50, and we're just barely above 44.50. So a lot of work to do before we would get to that point. I want to show you something though, because of my CPA brain and all the analysis I like to do. I'm going to show you a quick little spreadsheet. I probably could just describe it. Maybe it might be better because it's going to be hard to read or follow along. But essentially what I did with this spreadsheet, I'll just show you the spider, what I've done. Since the beginning of the year, all I did is I took the spider and I went back and I put in the open and the close. And so what I wanted to do was to see, basically it's another way of looking at accumulation distribution. I looked at the close to the close. So from the December 31st close to the January 3rd close, that's the difference. So we went up $2.75 to open the year. Now from the open to the close, we actually went up $1.41 during the day. Part of that 275 was the gap up from the close to the open, and that's shown over here. So in each of these columns, I've got the close to the close, the open to the close, and then the gap. So these two, the gap and then where you open from to the close, you add these two together and you're going to get the difference in the close to the close. The whole point was, going through this exercise, I went through And through the 18th, which was Monday, I was working on this yesterday during the day. But the total for the year, we were down $36 on the spider. 22 of it came at the open, and 14 of it was through the day. And this is net. So this is all of the days combined. Not sure how useful that is, but one thing I do like to do, the last high, when I was showing you the neckline on the S&P 500, that last high was on March 29th. That was the close right here. We actually closed at 461.55. So you can see that was the highest close. And then we started moving back down. If you go all the way out here to the right-hand side, what I did is I looked at the close to the close, the open to the close, and the gap since March 29th. And so I'm just evaluating this last move to the downside, not including yesterday. Again, I was working on it before I had yesterday's close. And so we've gone down $23 on the spider since March 29th. So the spider's down 5%. Again, this was before yesterday. It gapped down 889, and then it sold off during the day 1469. So roughly 2/3 of it, or about 60% of it, of the selling occurred during the day from open to close. And so of the 5.11% drop, 3.18% of it, 60% of it occurred during the day. So there's still distribution taking place. What I wanted to do was to see, okay, is this mostly just gap downs on a net basis? Is the market really prepping to go higher? Are we seeing accumulation? Is most of it gap downs, and then during the day, we really don't see much selling? Well, that wasn't the case. We are still seeing selling. But what I found interesting is as I started looking at these other ETFs, so that was the spider. When I look at the QQQ, we've dropped 8.76% since March 29th. So the Qs are getting hit harder during this sell-off. And almost 6% of it, or a little bit of a higher percentage, is occurring during the day. And as I go through these sector ETFs, what I'm going to focus on really is this 2202 right here. This is the amount of either buying or selling that's taken place during the trading day since March 29th. And so when I looked at technology, I can see that it lost $16 since March 29th, and almost 11 of it was during the day. So we're still seeing a lot of selling during the day in technology. Discretionary has gone down over $12. A little less than half of it is during the day. A little bit more than half is at the gap open, but still it is losing ground during the day. Communication services, almost all of it has been lost during the day. So you're seeing distribution continue on the XLC. XLI, industrials, again, mostly selling during the day. Financials, mostly selling during the day. Now we start getting into the defensive groups. And this is where I found it interesting. During the day on the XLV, since March 29th, we've been going down. During the day, the XLV healthcare has been bought. It actually has moved up during the day on a net basis since March 29th. Consumer staples is the best one yet. We've actually seen gap downs on the XLP, but we've seen rallies during the day. So you're still seeing money coming out of consumer discretionary. You're seeing it come out of technology, communication, all 5 of the aggressive groups it's coming out of. We're seeing money going into the XLV. We're seeing money going into the XLP. We're seeing a little bit into the XLRE, which is real estate. We're showing money rotating into utilities. We're seeing money rotating into energy. And we're seeing it actually come out a little bit of materials. But I just thought that exercise was kind of fascinating because I'm looking for signs that are saying money is rotating back into the aggressive groups. Any sign I can find. And this is telling me the exact opposite. So yeah, yesterday was a great day. Today it looks like futures are going to get off to a good start. But is the market in good shape right now? Are we going higher or are we going lower from here? And I don't know that this tells us anything definitively, but it does kind of point me in that direction of, I don't think the selling is done. Why would during the day, market makers and their institutional clients can't get into trades based on gaps. Shares have to be bought during the day. That's the only time it's liquid enough to buy enough shares to satisfy institutional clients. It has to happen during the day. And right now, the intraday open to close action still is favoring defensive groups. So I don't know. I wanted to share that, take what you want from it. Maybe you take nothing from it. Maybe you think, hey, yeah, we're in a lot of problem. We got a lot of problems because of it. Completely up to you how you want to analyze or interpret that data. But I thought it was interesting data to share. So looking at the S&P 500 chart, the period I was talking about was right here. So we knew the market went up. I'm still thinking a lot of that move to the upside had to do with options expiration. And a lot of this move was intraday buying of technology and consumer discretionary and communication services. All of a sudden, they caught fire out of nowhere. And oh, by the way, there was a ton of in the money puts that were sitting on the table right when all of that buying began. So no one will ever convince me otherwise. I think that was highly manipulated by the market makers in essentially squashing everybody's put value. Anybody who was trading puts and felt rich on March 14th was left holding an empty bag probably by the end of that week because of this huge rally that took place. So when you look back at 2022, I see a little bit of a rally that came off a panicked low, which is normal. You're going to see snapback rallies during, these cyclical bear markets, whether you want to call this a bear market or not. It's certainly acting a lot like one. But you see a lot of these snapback rallies. We saw one there, we saw one here. And then of course here, I just thought that was more options related. Outside of those three times, for the most part, everything we see is bearish. So it's hard to look at this pattern and think bullish thoughts when I just showed you what I just showed you in terms of the accumulation distribution. Again, does it mean anything? I don't know. I think it does. I think if institutional clients, if Wall Street was really moving into aggressive areas, I think it would show up in something like I was just showing you. I think we would start to see money rotating much more heavily towards aggressive areas, and not just during snapback rallies or not just during option expiration week, but all the time. It shouldn't just be limited to just a couple of periods when the market's panicked or hits a panicked low or has options sitting on the table. So we'll see what happens there. Anyway, there is your S&P 500. The NASDAQ also bounced back yesterday. Hasn't gotten through the 20-day. But I think, again, if we're going to consolidate back and forth, with which I think is really possible, if we continue to chop, and we could do this for a while, it'd be very, very frustrating trading. And in my opinion, one of the hardest periods to trade, because you just don't know what to trust. You move up for a little bit and then all of a sudden you're right back down again. And then you start turning more bearish and then it's right back up again. That, if you're chasing moves, that can get really costly. So we'll see what happens, but just be careful. I would continue to trade fewer shares. This is not the last 2 years in terms of how you approach trading. You should not be looking at this market like you've been looking the last 2 years. I think this is a much more difficult, much more volatile, much more choppy. And I think going to be, in the end, it's going to be difficult to trade frequently, to trade too. I think one of the problems is that you'll probably overtrade if you're trying to catch all these moves back and forth. And overtrading normally leads to losses. So just be careful, I think, right now is kind of the theme. All right, let's talk a little bit about earnings and Netflix. Well, let me pull up the symbol summary here so you can see the chart, or the price on Netflix right now, down $99, almost $100. It's not a misprint. 348 was yesterday's close. 248 is pre-market, down $100 on their news of falling subscribership for the first time since 2011. Not good there. Let's see, a couple of others. IBM reported up 2 3/4, been going mostly sideways. If it opens at 132 and change, you can see it's going to open right up here near this high. We'll see whether or not we can sustain that move. If we can, then I think we have a chance to get up into the 136, 138 range. But IBM has been such a disappointment for a long time. It's just one of those, it's like a no-fly zone. For me, it's a no-trade zone. I just not interested in trading IBM. Not now. I mean, it's just got to show me some more things, mostly on the long-term chart. IBKR, Interactive Brokers, came up a little short on their estimates, 82 versus 83. And you can see the stock down a couple percent this morning. So Interactive Brokers. OMC, one of our portfolio stocks, actually had a pretty nice report. They beat $1.39 versus $1.28, and the stock up 3% this morning. Looks to be getting back up above its moving average, trying to keep this trend line in play. I think this was the one I mentioned in our weekly portfolio report. I try to mention one of the 10 stocks in each of the portfolios and just draw, something that's piquing my interest. And in this case, I think it was OMC that I drew the trend line. So we bounced right off of it, came out with earnings, and we seem to be in pretty good shape after reporting earnings. So we'll see how that holds up today. This morning, Procter & Gamble reported only up a fraction, roughly 0.3%, but they did beat $1.33 versus $1.28. An interesting one was ASML. This is in the semiconductor space. Semiconductors have been getting hit hard, and you can see ASML's chart. Well, it's up 5% today, 5.4%. They beat 359 versus 189. When I see numbers like that, I'm wondering, why is this stock trending down? But I didn't see the rest of the report. I don't know what revenues did. I don't know what their outlook was, but they are getting a nice positive reaction, at least to start the day. But this is just taking it back up to the moving averages. We still have to get up above about 710, 715 to take out that late March high. So it's got a lot of work still to do, but it looked like a good report based on earnings, and the reaction seems to be pretty good here. One company that I really liked going in into earnings was ANTM. They beat 8.25 versus 781. Stock up $15 or almost 3%. Look at this move to the upside. When the market is struggling and chopping, and you get a stock like Anthem that's been going straight up, tells me Wall Street's been building a position. Now we find out why. Great report, and in this case, great reaction, at least to start the day. But it's not always easy. I do want to show you one other one. This is CMA, and CMA was one that I liked going into earnings. It's probably one of the best relative performers in the banks, and they missed. I've seen a lot of misses in the banks, by the way. That's where most of the misses are coming so far, have been the banks. CMA, $1.37 versus $1.38. Now you might say, well, it's just contained in the banks. That's a good thing. We're not seeing too many misses elsewhere. Well, the problem is if banks are missing their earnings and not performing well, and especially if it's because has anything to do with loan losses, you will see banks become much more conservative. And if they become more conservative and don't lend as freely as they've been lending, that also will help to choke out the economy. So you got to be careful when the banks aren't reporting well. I think I looked here and there were 5 companies that missed earnings that I see. 3 of them were banks. Another one, Interactive Brokers, is in the financial area. And then Baker Hughes is the only other one. I'll show you that one in just a minute. But anyway, CMA down 2.25%, still going sideways, which is actually pretty good when you look at the bank chart, because the banks have been going straight down. So the fact this one's been going sideways, that's why we've been seeing that relative strength. It'll be interesting to see what happens to relative strength today and going forward after missing by a penny. All right, Baker Hughes, this is the last one I'll give you. Baker Hughes missed 15-cent profit. They were expected to have 19-cent profit. Stock only down 2.33% though, 35.88, which takes us down here below the 20. I just see maybe some sideways consolidation. Maybe we get down to the 50. We could have had a negative divergence. Can't see it on this chart. Let me go ahead and pull that up and see. We'll use this as one of the 3 you must see. Yeah, there's a negative divergence. So higher prices, lower PPO. We're going below the 20-day with earnings. I would expect we're going to go down to test this 50-day moving average. That's what I'd be looking for on Baker Hughes. Let's see, a couple of others that reported. We'll use them. One company, LRN. This is Stride. They've been trying to make this breakout above 38. Their earnings came out $1.02 versus 84 cents. The stock is up 4.5%, or was, when I looked earlier this morning. So we'll take a look at LRN. Let's get an update here. It's up 7%, 37.89, and actually market just opened. So there you go. Let's go back to the regular chart. Trying to make this breakout, and it looks like it is gapped up above the prior highs. So I like it when companies do that. I wouldn't be surprised to see a strong day. We might see intraday selling, and then if it comes back up and breaks to a new high, that could be a sign that the stock is ready to run. So LRN would be an interesting trade. This is going to be an aggressive trade. Anytime you get news out with earnings, you can get tremendous volatility. So it's not for the faint of heart here, but I do like the way it opened, and I like its earnings report. And then the last one, let's see, WTFC. This is another bank stock. They actually had a huge beat, 207 versus $1.54. And the stock was up pre-market almost 4%, but it looks like it's barely open. I don't know if it's actually opened or not. It's only 2,000 shares traded. Let's try it again. No, still the same number of shares. I'm not sure if that's some of these stocks open a little bit after the market opens. I don't know if that's a true reading. We'd have to come back and take a look, but it does have good support down around 87.50. So I'd like to see that hold. And then on a relative basis, WTFC, you can see has actually been climbing relative to the banks for a long time. So they came out with great numbers, but when you look at their relative strength versus banks, it's been very strong. So I would have expected, and now we are getting a little bit more, still not much volume though. Try one more time. Maybe it's just not going to trade a whole lot of volume. Anyway, it was a pretty nice report, and it is one of the leaders in the bank space. All right, let's get a quick update on the market and then wrap this thing up. Dow up 274, S&P up 25, NASDAQ up 48. If you had told me this last night around 5 o'clock, 6 o'clock, when I was looking at Netflix and all the other growth stocks that were getting hit pretty hard, if you had told me that we were going to open up this morning, I would have said no chance. So that's good on the surface. The question is it just a gap up, or do we actually see accumulation continuing throughout today as we did yesterday? That's what I would be looking for. Anyhow, that's it for me. Listen, have a great day. I'll be back tomorrow morning, Thursday morning, over at Stock Charts TV for your next Trading Places Live episode. You can join me over there. Just simply 9 o'clock, click right here, and come on in. Love to have you. Everybody have a great day, and watch to see how we trade intraday, not just here at the open. Happy trading, everybody.